Welcome back to another edition of Talk Tickers. We are diving straight into the deep end today. You know, for the last couple of years, every conversation we've had about the future, about the economy, it's all revolved around AI.
Always. The chips, the models.
Exactly. We've been looking at it through this, very specific lens. We look at the software, the chatbots, the digital brain.
But we totally forgot about the body. We forgot what it takes to actually power that brain to keep it alive.
And that's where the whole narrative is shifting. I mean, right now we are moving from this era of code to an era of concrete and copper. The phrase of the year has to be the electron deficit. The U.S. is just facing this wall of demand for electricity that we haven't seen in generations. And that brings us to today's deep dive. We're unpacking the Q4 and full year 2025 results for NextEra Energy, ticker NEE.
This was the big one. This call happened on January 27, 2026. And look, let's be honest. Utility earnings calls are usually where excitement goes to die.
Right. You tune in for the dividend yield and go back to sleep.
Exactly. But this felt different. This wasn't really a utility update. It felt more like a logistics briefing for the industrialization of AI.
NextEra is trying to change its whole identity. They don't want to be just the power company anymore. They want to be seen as the default infrastructure builder for the tech giants.
It's a bold pivot.
Yeah.
And you've got the market, which is hungry for growth, but we're still dealing with, interest rate drag, policy headaches. So this earnings print was a massive test of that new identity.
So did they pass? That's the real question. Let's get right into the numbers. We always start with the snapshot. And, looking at that morning trading session, it really looked like they might have failed.
Oh, yeah. A classic head fake.
Yeah.
A classic algorithm-driven head fake. If you were just watching the pre-market, you might have panicked.
Let's break down why. So the headline numbers hit the tape. JAP EPS comes in at 73 cents, which is a solid jump from 58 cents the year before. Adjusted EPS was 54 cents.
Which beat by a penny. So not a huge beat, but a beat.
Right. So bottom line. They're efficient, they're profitable. But then the algorithms scan the revenue line.
And that's where the red flag went up. Revenue came in at $6.5 billion. The street and, the trading bots were looking for closer to $6.8 billion. That's a nearly $300 million miss.
Which, in this market, usually triggers an immediate sell-off.
And it did. The stock dropped, about 1.1% instantly in the pre-market? Looked like it was going to be a rough day.
But then the humans woke up. The real money stepped in.
This is the tell. This is the signal in the noise. The stock didn't stay down. It recovered, it rallied, and it closed up almost 2% at $87.15. But the key is the volume, 15.1 million shares.
The average is under 10 million.
Right. So that's high conviction buying. That's accumulation.
So why? Why did the big institutions just ignore a nearly $300 million revenue miss?
Because in this business utility development, revenue recognition is lumpy. It's all about timing. Did a project come online December 31st or January 2nd? It's just noise. The smart money looked right past that and straight to the guidance.
And management was pretty explicit there.
Very explicit. They said they're targeting the high end of their 2026 EPS range, which is $3.92 to $4.02. And they reiterated that long-term outlook.
That's the 8% annual growth.
8% annual growth projected all the way through 2035. That is a decade of compounded, predictable growth. If you believe that, you ignore the quarterly noise. The market bought the narrative, not the headline.
And that whole narrative is summed up in one quote from CEO John Ketchum on the call. He said, "America needs more electrons." It's so simple, almost primitive, but it feels like a most important economic statement of the year.
It's urgent. And it's forcing a complete change in the business model. This isn't just plug in and pay anymore. They kept hammering this concept of BOJA.
Bring your own generation. It sounds like a potluck dinner invite, not a grid strategy. Break this down for us.
Okay, so historically, if a big car plant moves into town, the local utility hooks them up. The cost of all that new infrastructure gets spread out across the entire rate base. Your bill goes up 50 cents, my bill goes up 50 cents. We all subsidize it.
Because it brings jobs and growth.
Right. But data centers completely break that model. They are so massive.
Yeah.
We're talking gigawatts. The power of entire cities in just a few buildings. You can't ask regular people to subsidize that.
It would be political suicide.
Totally. If grandma's electric bill doubles so Google can train a chatbot, the regulators will burn the utility to the ground. So BYOG means the tech companies, the hyperscalers, they have to pay for their own generation assets.
They bring the capital for the solar farm or the battery bank that serves them?
Effectively, yes. They bypass the whole affordability issue for regular customers.
But here's the friction point. I mean, these tech companies are incredibly impatient. They want power yesterday. They can't wait 5 years for a permit.
And that is where NextEra's strategy gets really clever. They call it the hook. They know they can't build a new nuclear plant in 12 months, but they can deploy solar and batteries that fast.
So the hook is just speed.
All speed. The pitch is, sign with us. We'll get you running on renewables and storage immediately so you can turn your servers on. Then, once you're our customer, we'll build a heavy-duty gas or nuclear base load behind it for the long run. It's a brilliant customer acquisition tool.
But to sell speed, you actually need the goods. You can't be waiting on parts from overseas.
And this is their moat. This is the competitive advantage that I think people really underestimate because it's just boring supply chain stuff. They said on the call they have solar panels and batteries secured through 2029.
4 years of supply, locked in.
Locked in. And even more critical right now, gas turbines. They have slots secured with GE Vernova for 4 gigawatts of gas generation.
Why does that matter so much? Can't anyone just call up GE and order a turbine?
Not right now, no. The supply chain is incredibly tight. If you're a smaller developer, you're probably stuck on a wait list. So if you're a hyperscaler, who do you sign with? The guy who hopes he can get a turbine in 2028 or the company that has one ready to go?
NextEra has the hardware. That reliability has to command a premium.
It creates a two-tiered market. There's NextEra, and then there's everyone else fighting for scraps.
So let's talk about where all this hardware is going. They kept using the term data center hubs. The scale here is, it's hard to wrap your head around. They're discussing 20 potential hubs now, and they expect that to hit 40 by year end.
And the internal goal is 15 by 35. That means 15 gigawatts of new generation just for data centers by 2035. But did you catch the CEO's little aside on that?
Oh, yeah, he went off script. He said he'd be disappointed if they don't double that.
He thinks they can hit 30 gigawatts.
Yeah.
Just to give you some context, 30 gigawatts is roughly the entire power capacity of a country like Argentina. They want to build an Argentina's worth of power just for American data centers.
That is just, it's wild. Let's look at the engines building this. You've got the developer arm, Energy Resources, and then the mothership, Florida Power and Light. Energy Resources seems to be on fire.
It's a machine. The backlog, signed contracts just waiting to be built, is at roughly 30 gigawatts. And just in the last 3 years, they've originated or found 35 gigawatts of new projects.
Let's pause there. 35 gigawatts.
If that 35 gigawatts were its own company, it would be the 4th largest public utility in the U.S. Their new business is bigger than almost everyone else's total business.
And the speed is ramping up. 3.6 gigawatts added to the backlog just since the Q3 call.
And look at batteries. 2 gigawatts placed in service in 2025. That is a 220% increase over 2024. This isn't a science experiment anymore. Batteries are essential for that hook strategy.
Okay, then there's Florida. FPL. I feel like people dismiss this as the boring part, but the economics of Florida are just incredible.
If Florida were its own country, it would be the 15th largest economy in the world, a $1.8 trillion GDP, and it's growing.
And NextEra has a regulated monopoly on the best parts of it.
That's the key phrase, regulated monopoly. They just finalized a new 4-year rate agreement. Their return on equity, the profit they're allowed to make, is set at a midpoint of 10.95%.
Just good.
It's credible. In the utility world, you fight for 9%. Getting nearly 11% guaranteed is a cash printing machine.
But they also have a Florida version of DYOU, right?
They do. They call it the large load tariff. It's a protection mechanism. Data centers are welcome, but they pay for their own grid upgrades. This protects the local economy, and they're already in talks on 9 gigawatts of load in Florida alone.
And somehow they've kept bills low.
30% lower than the national average. That's their political shield. As long as bills are low, regulators let them build.
Okay, I want to pivot to technology. Because for utility, they seem surprisingly tech forward. And I don't just mean solar, I mean nuclear.
We're seeing a real renaissance, but NextEra is playing it very smart. They're not trying to build giant new plants that go billions over budget.
They're focusing on what they already have.
Exactly. First, you have the Duane Arnold plant in Iowa, backed by Google. But the real hidden value, the sleeper asset, is their existing merchant fleet, Point Beach and Seabrook.
These are the plants up north, not in the Florida rate base.
Right. They sell power on the open market. They have 1.7 gigawatts of capacity there. Now listen to this math. They mentioned that the Point Beach extension, which was only 14% of that capacity, added 3 cents to EPS.
3 cents doesn't sound like a lot.
In isolation, no. But do the math. If 14% gets you 3 cents, repricing the other 86% could potentially add another, 18 to 21 cents of EPS.
And that's pure profit margin expansion. No new construction, just selling the same electrons to a richer customer.
Precisely. Instead of selling on the wholesale market for maybe 4 cents a kilowatt hour, you sell to a data center for 8 or 9 cents because they need that 2047 carbon-free power. It's the most valuable electricity on the grid.
What about SMRs? The small modular reactors. Everyone on Twitter is talking about them.
They are looking. They're being the adult in the room. They have a team evaluating 12 different SMR makers, but they were crystal clear. SMRs are not in the base financial plan. It is upside only.
That feels prudent. Refreshing, actually.
They want risk sharing. They're not going to bet the farm on unproven tech unless the government and the hyperscalers step up first. But if it works in the 2030s, it's all gravy.
And one tech partnership that is real today is Rewire with Google.
This is fascinating. This isn't NextEra selling to Google. This is NextEra buying from Google. They're using Google's cloud and AI to run their own grid more efficiently.
What does that actually mean?
Predictive maintenance. Using AI to spot a transformer that's about to fail, optimizing power flow. At their scale, squeezing out another 1% of efficiency is tens of millions of dollars straight to the bottom line.
We have to talk risks, though. It's not all perfect. Interest rates were a drag.
They were. Financing costs dinged corporate results by about 12 cents a share. That's real money. They have hedges in place, but yeah, the cost of capital matters.
And the PJM drama.
The transmission line, yeah. It's a $1.7 billion project with Exelon, and there's a lot of local pushback. The classic NIMBY problem, not in my backyard.
Everyone wants AI, nobody wants the power line.
Exactly. They expect a decision next month, but it's a reminder that politics can kill a good project.
And finally, the gas pipelines. They bought Symmetry Energy. Why does a power company need a pipeline?
To guarantee the fuel. If you're going to promise Google you can run gas turbines when it's cloudy, you better be damn sure you can get the natural gas. By owning the pipeline, they're hedging their fuel risk.
Okay, we've covered the earnings, the strategy, the risks. Now let's move to our special segment. This is where we take off the prudent investor hat and put on the hedge fund investment committee hat.
The "this is not financial advice" segment.
Exactly. We're pitching a theoretical trade idea. High risk, high concept. What's the trade?
Okay, here's the pitch. We're calling this the zombie nuke call option.
I love it already. Break it down.
The thesis is simple. The market is pricing NextEra based on its renewable backlog and its steady Florida growth. It is pricing the nuclear assets, Point Beach and Seabrook, as boring, legacy, low-margin wholesale power plants.
But you think they're mispriced.
I think they are potentially the most valuable real estate on Earth. Here's the trade. You buy NextEra specifically as a play on those 1.7 gigawatts of capacity being converted into behind-the-meter dedicated power for a massive AI cluster.
Why is behind the meter the magic phrase there?
Because building new nuclear is almost impossible. It takes a decade, it's always over budget. But an existing nuclear plant with an operating license, that runs 24/7 with zero carbon. That is a unicorn. It's an irreproducible asset.
So the logic is you're not betting on some sci-fi SMR in 2035. You're betting on the old nukes right now.
Precisely. We're betting on the old nukes becoming exclusive batteries for data centers.
So what's the dream scenario here, the upside?
Look at the deal Constellation did with Microsoft. The premium they paid for that dedicated nuclear power was massive. If NextEra signs a similar deal for the full 1.7 gigawatts, the earnings repricing isn't incremental, it's a step change. That 21-cent EPS uplift we talked about could double or triple.
So you're buying a safe utility, but you're getting a free call option on a nuclear AI monopoly.
That is the trade. The downside. You own a great utility growing at 8%. You sleep well at night. The upside. You own the heartbeat of the AI revolution, and the stock reprices like a tech company.
That is actually a very compelling thesis. It turns a defensive stock into an aggressive growth play.
That's the best kind of trade. Asymmetric risk. Heads you win a little, tails you win a lot.
All right, let's wrap this up. Recap for the listener.
Strong beat on earnings. The revenue miss was just noise, and the market figured it out. The backlog's at record levels. The demand for electrons is very real, and NextEra has the inventory to meet it.
And that line between tech stock and utility stock it's vanishing. NextEra is positioning itself as the hardware layer of the AI stack, if NVIDIA is the chips.
NextEra is the socket. You can't run the chip without the socket. That's a great way to put it.
As always, do your own research. We're just two voices in your headphones exploring the data.
Question everything.
Thanks for diving deep with us on Talk Tickers. We'll catch you on the next one.